Imagine this. You've done your homework. Your stock picks, solid. Charts look great. You feel, pretty much bulletproof. But then, wham, the market just decides to play demolition derby with your entire portfolio. Maybe some unexpected overnight news, a surprise economic report, or just a sudden sweeping downturn hits, and you watch everything plummet, even though your individual trade ideas were actually spot on. It's just a gut-wrenching feeling, right? And it's precisely what we're trying to arm you against today. Welcome to the Deep Dive. Today we're jumping into what we're calling the art of the deliberate hedge. This is a really crucial strategy, especially for you swing traders out there. Here's the core problem. As swing traders, you're holding positions for days, sometimes weeks. This intermediate timeline, it puts you in a unique kind of vulnerable spot. You're exposed to things like those big overnight gaps, unexpected weekend news bombs, major macroeconomic shifts, things that your traditional stop losses and even careful position sizing, well, they just can't handle alone.
Exactly. And while stop losses are, absolutely fundamental for managing risk on individual trades, they're reactive. They're designed for when one specific stock's thesis goes wrong. That's their job. But they really fall short when you're facing those broader portfolio level or systemic risks, the kind that can just wipe out weeks of good trading across your entire book. And that's precisely where hedging steps in. It's a proactive necessity. Think of it like essential armor. It lets you anticipate, not just react to those, portfolio crushing market shifts.
Right. So for you, our listener, our mission today is really to pull back the curtain on hedging. We're going to break down when and, importantly, how to use it and show you how it can not only preserve your hard-earned capital, but also, maybe just as importantly, protect your mental sanity as a trader, keep you in the game longer.
Oh, that's a critical point. And it's often overlooked, the mental capital aspect, the psychological burden of watching your entire portfolio free fall at the same time. It's immense. A well-executed hedge, it dampens that drawdown. It reduces the emotional stress. And that allows for clearer, more rational decisions during volatility instead of those reactive, emotionally driven ones. It basically buys you the headspace to think, not just panic.
Right. So if we're talking defense against market curveballs, let's really zoom in on that specific tightrope swing traders walk. What makes your situation as a swing trader uniquely vulnerable compared to, say, day traders or long-term investors?
Yeah, it really comes down to time in the market, but in a specific way. Unlike day traders who are flat, positions closed by the end of the day, or long-term investors who just ride out the big waves, you're holding for days to weeks. And that intermediate duration, it exposes you to significant risks. Those overnight price gaps we mentioned, unexpected weekend news, sudden macro data releases. Your traditional tools, stops and sizing, they're foundational, absolutely. But they're primarily designed for idiosyncratic risk.
Idiosyncratic, meaning specific to one stock, right?
Exactly. That's when the issue is specific to one holding.
Right.
Like a company misses earnings badly, or a technical pattern just fails completely. Stops protect you from being wrong on that particular stock.
Okay, and here's where it gets really interesting for me. Stop losses are fundamentally reactive. They only trigger after a bad price move has already happened. You can picture it, right? A market correction where all your carefully picked stocks hit their stops simultaneously. That's just chaos. A forced liquidation, really, not strategic risk management. It's like waiting for the car to crash before the airbag deploys and just hoping it's enough.
Precisely. And that's where hedging comes in. It's fundamentally proactive. It's a strategy to neutralize those broader portfolio level risks before they inflict maximum damage. It involves taking an offsetting position, something that ideally moves counter to your main holdings during a downturn to reduce those adverse price swings across your whole book. Think of it as evolving, moving from just a single trade mindset to acting more like a portfolio manager, seeing the entire forest, not just the individual trees. You're building a strategic defense for the whole thing.
Okay, so toolkit time. How do we decide which tool to grab? Is one better, or is it about the right tool for the right risk?
It's absolutely about the right tool for the job. Your stop loss orders, your disciplined position sizing, those are bedrock. Non-negotiable first line of defense. They're perfect for those unique individual stock problems we talked about. A pattern fails, bad company news hits. And, if your portfolio is already pretty well diversified with low correlation, maybe you hold an energy stock, a consumer staples company, a healthcare firm, those standard controls might actually be enough a lot of the time. The advantage there, simplicity, lower direct cost. The cost is just the loss you're capping on that one trade.
But, okay, what if your stock pick is genius? Totally right on the company, but the entire market decides to just fall off a cliff. Does your stop loss even matter then?
That's the exact scenario where hedging becomes, strategically necessary. Let's look at maybe 4 key situations where it really shines. First, managing systemic or correlated risk. This is huge. Let's say you have 5 long positions, all in tech stocks. Your biggest threat isn't one of them missing earnings slightly. It's a big macroeconomic event, like a sudden sharp interest rate hike causing the whole NASDAQ 100 to sell off hard. And it drags all 5 of your positions down at the same time. In that case, a single proactive hedge, like buying some put options on a tech-heavy ETF like QQQ, is way more efficient than just waiting for 5 individual stop losses to trigger in a cascade.
Right, one action versus 5 potential fires.
Yeah, exactly. Second, navigating binary events. These are those scheduled high-impact moments. Earnings reports, Fed announcements, big CPI data releases. They can cause huge overnight price gaps. And a traditional stop loss offers literally zero protection against a gap below your stop price. The market opens and you're already way past it. A protective put option, though, it creates a price floor. It essentially caps your maximum loss no matter how far the stock gaps down. It's like your emergency parachute for that specific event.
Okay, that makes sense for note events. What else?
Third, protecting unrealized gains. Let's say you've got a fantastic profit in a stock that's been trending beautifully, but you anticipate a short-term market pullback coming. Selling now locks in the profit, sure, but it also triggers a taxable event and forces you to figure out when to get back in. A short-term protective put lets you insulate those gains from that potential pullback. You keep your core position intact, ride out the dip with less pain, and hopefully continue the trend. You're essentially buying time and deferring the tax hit.
Yeah, the fourth.
And finally, number 4. Expressing a more nuanced market view. A stop loss is pretty blunt, right? It just says, my thesis is wrong, get me out.
Yeah.
A hedge, however, allows for more subtlety. It lets you say something like, look, I still believe my stock will go higher long term, but I'm genuinely concerned about the Fed meeting next week and what it might do to the whole market. It gives you the flexibility to mitigate those short-term broad risks while maintaining your conviction in your core positions.
Got it. So it's a shift, not just about cutting losses on one trade, but really protecting the entire ship, especially when you think a storm might be coming for everyone, not just one leaky boat.
Precisely. And once you've decided, okay, I need a hedge here, the next critical step is choosing the right type of hedge. Think of these as different overlays. They're designed to neutralize specific unwanted risks. And actually, choosing the overlay forces you to really articulate your specific fear. What are you really worried about?
Okay, let's break down the main types, starting with the widest net, broad market hedges.
Right. The purpose here is to neutralize systemic market risk. That's often called beta exposure. This is for when your fear is genuinely just the whole market is going down.
Nah.
Your instruments. Buying put options on broad market ETFs is common. Think the SPDR S&P 500 ETF, ticker SPY, or the Invesco QQQ Trust for tech-heavy exposure. More advanced traders might short index futures like the E-mini S&P 500, ES. You can use inverse ETFs, but honestly, proceed with caution there. They can have tracking errors and decay issues, especially if held longer term. These broad hedges are ideal for a reasonably diversified portfolio that generally tends to move with the overall market.
Makes sense. What if the fear is more specific?
That brings us to sector and thematic hedges. More targeted protection. The purpose here is to neutralize risks specific to an industry or maybe an investment theme. This is your go-to when you feel a particular sector is vulnerable, even if the broader market seems okay. Instruments typically involve put options on specific sector ETFs. For example, the VanEck Semiconductor ETF, SMH, if you're heavy in chip stocks, or the Energy Select Sector SPDR Fund, XLE, for energy holdings. These are really ideal for portfolios with significant concentration, let's say maybe over 40% in a single sector theme, like using QQQ puts, which lean tech, for a tech-heavy portfolio right before a CPI report if you fear a hot inflation number will disproportionately hammer those rate-sensitive names.
Okay, broad market, specific sector.
Yeah.
What's next?
Mm-hmm.
Sounds like it gets even more precise.
It does. For those playing an even more advanced game, there are pairs and relative value hedges. The purpose here is pretty sophisticated. It's to strip out almost all market and sector risk. You're trying to profit purely from the outperformance of one stock versus a closely correlated peer. How you do it? You go long one stock and simultaneously short an equivalent dollar value of a highly correlated but maybe weaker competitor. The classic example might be long Home Depot, HD, and short Lowe's, LOW. If you believe HD is better positioned right now, regardless of what the housing market or overall economy does, This is really for situations where you have super high conviction in a single stock's relative strength, but maybe low conviction in the overall market or even the sector's direction.
Wow, okay, so just choosing the type of hedge is a big decision.
It really is. And it's a powerful diagnostic tool in itself, like I said. It forces you to define your market thesis precisely. Any lazy thinking gets exposed. If you hedge with SPY puts, you're clearly saying, I fear a general market decline. If you choose QQQ puts, you're being more specific. I fear something that's going to hit tech harder.
Yeah.
That articulation of risk, invaluable.
Okay, let's talk about one of the parts that I think intimidates people the most, sizing. How much hedge do you actually apply? It feels like it needs to be this perfect mathematical equation, but you're saying that the goal isn't perfection, right? It's being roughly right.
Exactly. Roughly right is a great way to put it. You want to neutralize the desired amount of risk, not necessarily achieve perfect mathematical neutrality, which is often impossible anyway. Let's start simple with exposure-based sizing, sometimes called the one-to-one hedge. This is the simplest method, and it's great for hedging a single concentrated stock position against a specific event, like earnings. You basically match the notional value of the hedge to the market value of the position. So if you own, say, 500 shares of stock XYZ at $100 a share, that's $50,000 in exposure. You'd look to buy 5 put option contracts because each standard U.S. equity option contract controls 100 shares. Simple match.
Okay, that works for one stock. But what about a whole portfolio? Multiple stocks, different betas?
Yeah.
That's where it gets more complicated, surely.
It does, and that's where beta weighting demystified comes in. It sounds complex, but the concept is straightforward. Beta, simply put, measures how volatile your portfolio tends to be relative to a benchmark, usually the S&P 500. A beta of 1.0 means it generally moves in line with the market. A beta of 1.5 means it tends to be 50% more volatile up and down. So beta weighting calculates your portfolio's S&P 500 equivalent exposure. An intuitive way to think about it is to ask yourself, if the S&P 500 moves 1%, by what dollar amount do I realistically expect my entire portfolio to move?
So let's say you have a $100,000 portfolio with an overall calculated beta of 1.3. On average, it's going to behave somewhat like a $130,000 position purely in the S&P 500. That $130,000, that's your market equivalent exposure you might want to hedge against.
And how do you actually calculate that portfolio beta? Practically, you'd find the beta for each stock you hold. Most trading platforms provide this. You multiply each stock's beta by its current dollar value in your portfolio. Then you sum all those up to get the total beta-weighted dollar exposure of your portfolio. Once you have that number, that $130,000 in our example, you don't necessarily hedge the full amount. You might decide to hedge, say, 50% or maybe 75% of that total beta-weighted exposure, depending on your risk tolerance and the nature of the threat.
You know, just going through that process sounds like a fantastic way to actually understand your portfolio's true risk.
Yeah.
Beyond just looking at individual positions one by one, it feels like it's not just about managing risk, but maybe even revealing hidden risk you didn't realize you had.
Absolutely. That's a key insight. The very act of sizing a hedge can be an incredibly powerful risk discovery tool. So many traders, especially those focused on individual stock setups, are honestly unaware of their portfolio's aggregate sensitivity to the broader market. You might think you're diversified because you have 5 positions, maybe each risking only 1% of capital on a stop-loss basis. But if they're all high beta tech stocks, your actual systemic risk exposure is highly concentrated and much larger than you perceive. This beta weighting exercise forces that crucial portfolio level risk assessment. And just quickly on concentration and event risk adjustments, if your portfolio is heavily concentrated in a volatile sector, maybe use a more volatile index for your hedge, like the NASDAQ 100, QQQ, instead of the S&P 500, SPY. And for binary events like earnings, options implied volatility IV is your friend. The price of an at-the-money straddle, that's buying both a call and a put right at the current price, can actually give you a market estimate of the expected price move, which helps guide how much protection you might want.
Okay, so you've picked your hedge type, you've sized it. But this isn't a set it and forget it deal, is it? It sounds like a hedge is a living, breathing position itself. What does managing it look like day to day?
Far from set and forget. You nailed it. Think of the hedge not as a static shield you put up once, but as a dynamic defense that needs constant calibration. It definitely has a distinct life cycle: initiation, maintenance, and finally, exit. So, initiation. The the win. Critically, a hedge should not be a permanent fixture in your portfolio. That gets expensive and drags performance. You need specific, predefined triggers for putting one on. What might this be? Maybe technical deterioration in the broader market, things like the S&P 500 making new highs, but key indicators like the advanced decline line making lower highs, that divergence signals underlying weakness, or volatility spikes. The VIX, the fear gauge, spiking up above 20 or maybe 25 often indicates rising fear and increased demand for insurance, making it a timely moment to consider hedging. And of course, a known event horizon, a specific high-impact event coming up, like a CPI report, a Fed decision, or major earnings for a large holding.
Okay, so you've got your trigger, the hedge is on. You're not done, though, right? What's the ongoing work?
Exactly. Maintenance and adjustment are absolutely key. One big part is managing delta. Remember, an options delta measures how much its price changes for every $1 change in the underlying asset. As the market falls, a put options delta becomes more negative, closer to -1. This means it starts hedging more powerfully. You could actually become overhedged if the market drops significantly, and you might need to trim the hedge back a bit. Conversely, if the market rallies strongly against your hedge, the put's delta decreases, becoming less sensitive. If the underlying risk you were hedging still persists, you might actually need to add to the hedge to maintain the desired level of protection.
Okay, so it reacts to the market, and you have to react to its reaction.
You got it. You also have techniques like rolling. If your options hedge is getting close to expiring, but the risk you put it on for is still very much present, you roll it. That means closing the near-term option position and opening a new similar one, but with a later expiration date. And there's rotation. Maybe your market view evolves. You might have started with a broad SPY put hedge, fearing a general downturn. But then as things unfold, you realize the weakness seems really concentrated in, say, the tech sector. You could rotate your hedge by closing the SPY puts and opening QQQ puts to target that specific weakness more effectively.
And then, just as critical as putting it on, knowing when to take it off. What's the exit strategy look like?
Indeed. The exit strategy, the when to unwind, requires real discipline. You can't just hold it forever, just in case. First, obvious one. The catalyst has passed. For those event-driven hedges earnings, CPI once the event is over and the dust settles, remove the hedge promptly. Holding it longer just means paying more time decay. Beta. Remember, options lose value every single day as they approach expiration. It's like an ice cube melting. For hedges triggered by technical weakness, you look for technical confirmation of strength to get out. Maybe the market reclaims a key moving average, or you see a clear bullish breakout pattern forming. And always, always conduct a cost-benefit analysis. Continuously ask yourself, does the perceived risk right now justify the ongoing cost, that time decay of holding this hedge? That just-in-case mentality gets very expensive very quickly. You need clear, predefined criteria for unwinding the hedge.
It definitely sounds like a powerful tool, but like you said, any insurance comes with a price tag. It's not free protection. What are the costs? What are we actually giving up for this potential peace of mind?
Absolutely. And understanding the cost is crucial. Hedging is fundamentally a trade-off. You accept a known, smaller cost up front for protection against an unknown, potentially much larger loss down the road. So the direct costs are the most obvious, things like the option premiums you pay. These premiums are heavily influenced by implied volatility IV. Higher fear in the market means more expensive insurance, and they are always subject to time decay, or theta, that melting ice cube. There are also commissions and fees for every transaction, buying, selling, rolling, and they definitely add up, especially with active management. And if you're using futures, there are futures carry and rollover costs to consider.
Okay, premiums, commissions, what else?
Then there are execution costs, often called slippage. This is simply the difference between the price you expected to trade at and the price you actually got filled at. This can be more significant in fast-moving or less liquid markets. You can minimize it by using limit orders instead of market orders, trading highly liquid instruments like options on SPY or QQQ, and trying to avoid trading during really illiquid times, like right at the market open or close sometimes.
And you mentioned something earlier about the hedge maybe not perfectly matching the portfolio.
Yes, that's basis risk. This is really important. It's the risk that your chosen hedging instrument might not move in perfect or even near perfect correlation with your portfolio. For example, using SPY puts, S&P 500, to hedge a portfolio full of small-cap tech stocks might not work perfectly because those stocks might fall much harder than the broad market index. There's a mismatch, a basis risk. The key is to choose hedging instruments that are as closely correlated as possible to what you're actually trying to protect. And finally, the big one, often the most visible cost in hindsight, opportunity cost, or performance drag. If that downturn you feel doesn't actually materialize and the market rallies instead, your hedge, like those put options, will lose money. That loss directly reduces your portfolio's overall gains. It's an explicit choice you make. Prioritize capital preservation during periods of uncertainty over potentially maximizing profit if the market rips higher.
Right. So you're essentially paying an insurance premium. And like car insurance, you hope you don't need it, but if you do, you're glad you paid. But if you don't need it, that premium is just gone.
Yeah.
You're choosing resilience over potentially higher, but definitely riskier returns sometimes.
Exactly. And that leads to a really counterintuitive point about judging hedges. Here's the truth. A successful hedge, one that did its job perfectly, might very well end up losing money on its own P&L line. Its victory isn't measured in its own profit. It's measured in how well it protected your primary positions, how much it reduced overall portfolio volatility, and maybe critically, how it gave you the clarity and control to act rationally when others were panicking. A really common mistake traders make is judging a hedge solely by whether it made money or lost money. Its purpose isn't usually to be a profit center, it's to reduce risk and enable better management of your core portfolio. That's the mission.
Okay, that's a really important shift in perspective. So if we're not just looking at its P&L, how do we properly evaluate if a hedge was effective?
We need to use both quantitative and qualitative measures. Quantitatively, the dollar offset method gives you a pretty objective measure. Let's say your core long portfolio lost $15,000 during a market correction, but your hedge, maybe SPY puts, gained $12,750 during that same period. Your offset ratio is $12,750 divided by $15,000, which is 85%. Accounting standards often consider an offset ratio between 80% and 125% as being highly effective. So quantitatively, that hedge did a great job.
85% offset sounds pretty good, but what about the other side, the qualitative?
Right, because the numbers don't tell the whole story. The true success often lies in the qualitative assessment. We need to look at the strategic and behavioral impact. Ask questions like, did it achieve capital preservation? Did it keep your portfolio drawdown within your predefined maximum acceptable loss? For instance, did it prevent a potential 15% loss and keep it contained to only 5%? That's a huge win. Was it a behavioral anchor? Did having that protection in place provide the psychological stability you needed to actually stick to your trading plan for your core long positions? Did it prevent you from panic selling good stocks at the worst possible time? And did it offer enhanced flexibility in decision making? Did having the hedge buy you valuable time and, crucially, mental clarity to reassess the market calmly? Did it allow you to make rational decisions about your portfolio rather than being forced into liquidating everything indiscriminately just to stop the bleeding?
So a hedge that technically loses, say, $500, but allows you to hold on to a core position that avoids a $5,000 loss or enables you to capture a later $10,000 gain. That's actually a critical success. It's about the holistic portfolio level outcome and maybe even your own sanity.
Precisely. You have to look at the entire picture of the core portfolio plus the hedge and also factor in the behavioral benefits.
Okay, theory is great, but let's make this real. To bring these concepts to life, can we walk through maybe a few common scenarios that swing traders actually face? Those moments when a deliberate hedge could really make the difference.
Absolutely. Let's look at 3 common cases. First, case 1. A pre-earnings hedge on a high beta tech stock, let's say NVIDIA scenario. You hold 200 shares of NVIDIA, bought at 150, so it's a $30,000 position value. Earnings are coming up in 3 days. You're bullish long term, but you're worried about a classic post-earnings sell the news reaction, maybe a sharp gap down. You know a stop loss set at $140 is completely useless if the stock opens the next day at $125. Decision framework. This is clearly an idiosyncratic risk specific to NVIDIA and its M-driven earnings, the perfect candidate for a protective put. Execution. You buy 2 weekly NVDA put option contracts. Maybe strike price $135, which is about 10% out of the money, meaning below the current price. This makes the premium cheaper and targets protection against a significant drop while minimizing the cost of time decay because it's a short-term weekly option. Let's assume the premium costs $2.50 per share, which is $250 per contract. 100 shares. Total cost for 2 contracts, $500. Outcome. Scenario A, NVDA collapses to $120 after earnings. Your 200 shares lose 30 shares. That's $6,000.
But your $135 puts are now $15 in the money. $135 strike $120 price. So they gain at least $15 per share. 200 shares equals $3,000. Your net loss is the $6,000 stock loss minus the $3,000 options gain plus the $500 premium cost to leave for $3,500. Still a loss, but way better than the $6,000 hit without the hedge. Outcome. Scenario B, NVDA rallies to 175 SIRS. Your shares gain $25 share. That's $5,000 profit. Your puts expire worthless. The $500 premium you paid. That was simply the cost of crucial insurance, and, importantly, the peace of mind that let you hold through the event confidently.
Okay, that's a clear, single-stock, event-driven example. What about broader market worries?
All right, case 2. A macro data hedge before a CPI report. Scenario. You manage a $200,000 portfolio, but it's heavily concentrated in growth and tech stocks, think Apple, Microsoft, Amazon, Meta, maybe Tesla. A key consumer price index, CPI report, is due in 2 days. You're concerned that a hot inflation number will trigger a sharp sell-off specifically in these rate-sensitive names. Decision framework. This feels like systemic risk, but it's highly correlated to a specific factor, interest rates impacting your concentrated sector, tech growth. So a single broad-based hedge, maybe tilted towards tech, seems superior to individual stops. Execution. Using QQQ puts, the NASDAQ 100 ETF heavily weighted in tech, makes sense here. First, you do that beta weighting calculation we discussed. Let's say your portfolio analysis shows a weighted average beta of about 1.2 relative to the NASDAQ 100. So your NASDAQ equivalent exposure is $200,000 portfolio value, 1.2 beta equals 240,000. You decide you want to hedge maybe 50% of this exposure, aiming for around $120,000 of notional value protection. If QQQ is currently trading at $400 per share, and each contract controls 100 shares, $40,000 notional value, you'd need 3 contracts, $120,000, $40,000, 3. So you buy 3 QQQ put contracts, maybe with a strike price slightly out of the money, like $390 expiring next week to keep the premium cost down. Outcome. Scenario A, CPI comes in hot, QQQ drops 4% to $384. Your portfolio, being slightly higher beta, might drop around 4.8%, 1.24%, which is a $9,600 loss. However, your $390 strike QQQ puts are now $6 in the money, gaining significant value. 6 $300 shares, $1,800 intrinsic value, offsetting a substantial portion of that $900 to $600 loss. Outcome. Scenario B, CPI is benign or cool, QQQ rallies 3%. Your portfolio likely gains around 3.6%, 1.23%, which is $7,200 profit. Your QQQ puts expire worthless. That premium was, again, a prudent expense for critical protection during a high-stakes macro event affecting your specific portfolio concentration.
Got it. And one more. Maybe something based on technicals.
Sure. Case 3. Hedging against deteriorating market breadth. Scenario. The main index, maybe the S&P 500, is grinding higher, maybe even making marginal new highs. But you notice troubling signs under the surface. The number of stocks making new 52-week lows is expanding, not contracting. And maybe a key breadth indicator like the advanced decline line is showing a bearish divergence. It's making lower highs while the index makes higher highs. Your portfolio is fully invested in various long swing trades, but you suspect this underlying weakness could lead to a broader pullback soon, even if the headline index looks okay for now. Decision framework. This is a developing, potentially negative market condition based on technical signals. Proactive protection seems warranted before things potentially get worse. Execution. Buying puts on a broad market proxy like SPY, S&P 500 ETF, makes sense. Since this is an evolving condition, not a single date-specific event, you'd probably choose a longer expiration date for the options, maybe 30, 45 days out. This gives your thesis more time to potentially play out and also reduces the immediate impact of time decay. Theta. You might start with a partial hedge, perhaps aiming to offset 25% of your portfolio's beta-weighted value initially, and you'd have a plan. If the negative divergence worsens or the index breaks key support levels, you might scale up the hedge to 50% or even 75% coverage. Outcome. Scenario A. The market does indeed correct, maybe dropping 8% over the next 2 weeks as the underlying weakness finally takes hold. Your SPY puts gain significant value, offsetting a large chunk of your core portfolio's losses during the decline. This proactive, data-driven hedge based on breadth deterioration was a major success in preserving capital. Outcome. Scenario B, market breadth actually improves, the divergence resolves bullishly, and the rally continues strongly. You then follow your predefined exit rules, likely closing the SPY puts for a relatively small loss as the technical reason for the hedge is no longer valid. You adhere to your disciplined entry and exit rules for the hedge.
Those examples really help illustrate the different situations and thought processes. Thanks.
You're welcome. And what's truly fascinating here, I think, is that for the really serious swing trader, integrating hedging isn't just like an optional extra. It feels like a logical evolution of their trading. It's moving beyond just speculating on individual stock setups to becoming a much more sophisticated manager of a truly risk-adjusted portfolio, thinking about the whole, not just the parts.
Okay, let's try and wrap this up then. For you, the listener, the key takeaways here seem to be: first, matching the right tool stop, sizing, or a specific type of hedge to the specific risk you're actually facing. Is it stock-specific, sector-specific, or market-wide? Second, embracing that idea of roughly right sizing, maybe using beta weighting rather than getting paralyzed by seeking mathematical perfection. Third, actively managing the hedge's full life cycle, having clear triggers for getting in, adjusting it, and just as importantly, getting out. Fourth, understanding those inescapable trade-offs. Hedging costs something, whether it's premium, commissions, or opportunity cost. It's insurance. And finally, judging its success holistically. How did it impact your total portfolio P&L, and maybe more importantly, your ability to manage risk and make clear decisions, not just looking at the hedge's P&L in isolation.
Well said. And by mastering this art of the deliberate hedge, you really gain a powerful